Hey, Steve Saretsky here. I'm with the legendary Hilliard MacBeth. So he is the author of When the Bubble Bursts, and obviously a bit of a media star, Twitter friend, and so thanks for coming by. First of all,
Nice to be here. It's great that we can meet. Having found each other on Twitter, and then we get to meet in person. It's wonderful.
yeah, absolutely, getting comfortable here on the couch.
Yeah.
Yeah. So, anyways, just wanted to talk to get your thoughts. I mean, obviously, a little bit about why you wrote this book, I guess, to begin with. So, when was this actually written?
Well, it was written over probably a year and a half, 2 years, up to about March 2015. So I started thinking about this probably in the middle of 2013, and really got down to writing it in about the end of 2014, early 2015, and it came out in March of 2015. So that was 2 years ago. And what I noticed was people. So I've been doing this investment thing for almost 39 years now, and I noticed that about 15 years ago, people started to get really interested in real estate in kind of an irrational way. Like they just, one of the things that I noticed was people believed that prices would always go up and never go down, and which I knew was wrong. But I suspected it was wrong. But I started to research it, and rather than kind of lecture my clients about all the dumb things they were doing with real estate, it was easier for me to write a book, and that way I could get all of these thoughts out without maybe losing friends over it.
Yeah, document it. So
yeah, exactly.
Obviously, it's a pretty aggressive title. So you wrote it, I guess 2014, 2015 sort of thing, kind of finished up. Do you obviously, I'm sure you take a lot of slack, a lot of criticism. How has this played out for you? Like, is this one of those things where it's hard to time the market and like the fundamentals, aren't quite there, and like it's gonna happen, or is it not gonna happen? Like where do you see it? Where are we right now today in terms of maybe Vancouver, Toronto, Alberta, that sort of thing?
I'm surprised. Like I really am surprised that we didn't see a bigger downturn in Alberta, because we in Alberta, where I'm based in Edmonton, and I have lots of clients in Vancouver, Calgary, and some in Toronto. But most of my clients are in Alberta. I'm surprised that prices haven't gone down more. The headline number, which is an index put out by the real estate industry, as you know, is somewhat misleading, because they leave out things like foreclosures and that sort of thing. But the numbers are like 5 to 10%, maybe 15% down from the very peak, and which is, in my mind, much less than what we're going to see. I'm sure that we're going to see eventually 30-40%. But the thing is that the prices, people are very optimistic in Alberta, and if they decide that they don't like the price that they're going to sell their house for, if they, in other words, if they had to sell their $1 million house by cutting it to 700,000, which would be 30%, obviously, they might just decide to take it off the market. And I think there's some of that. But there's also something that's very surprising to me, and that is that there's a lot of optimism of people, even though they see that the economy is terrible in Alberta, and they see that prices are soft. They learned, maybe in 08, 09, that if prices dip 5 or 10%, it's time to jump in and buy. And I see a lot of that. And I'm really surprised at people my age who have, offspring in their 20s and 30s, helping them to buy. They think, well, this is a great opportunity to get in, even when the younger generation doesn't really have the job or the income to support it. So that's one of the reasons I wrote the book. Was there's actually 60-year-olds whose retirements are going to be put at risk by getting too involved in real estate by helping other people.
Yeah, no doubt. What are your thoughts, I guess, what's going on right now in Toronto?
Well, it's crazy. Like I hear that there's bidding wars and prices going up, and I believe what I hear. I mean, obviously, I hear it from enough people that I know and trust that it's really happening. But when I looked, for instance, one of the arguments, if you try and press on them, they say, well, think of all the immigration, all the people moving to Toronto. So in my weekly note that I put out, my blog, I just wrote it up last week, and there's no evidence at all of population. In fact, Toronto population growth is below 1%.
Yeah, I saw that.
And population growth in Edmonton and Calgary is 2.1 and 2.3%. So there's no argument at all that makes any sense in Toronto, other than out and out speculation. They're in the grips of a very speculative fever that can only end badly.
It's interesting because I think a lot of people in the industry, I think similar to what everybody said here in Vancouver, is that it's this runaway price growth is from population growth and limited supply. So
Yeah.
I would be curious to get your take on that.
Well, the limited supply argument, that completely falls apart. So what we did a few weeks ago in the weekly note, we wrote up the density. So in Edmonton and Calgary, Edmonton, for example, the area of Edmonton has grown 13-fold in the last 45 years, and the population has only tripled. So that means the density has gone down to 75%.
Yeah.
The density in Toronto, which is the densest city, it's actually denser than Vancouver, I was a little surprised, is about 900 people per square kilometer. Vancouver is about 800 people per square kilometer. So I looked around the world, and Germany's a similar, it's a bigger country, obviously, but it's a similar economy to us in some ways. And the density in Munich is 4,200 people per square kilometer. So the idea that there's a lack of supply just doesn't hold up at all. It might be that the developers are building the wrong stuff, but there's no question that there's lots of supply. In fact, the housing starts just came out yesterday. For the third month in a row, is over 200,000 at annual rate. So I mean, there's no. The other way we look at it is the amount of investment. So in Canada, we've been investing more than 7% of our total GDP in real estate construction and renovation, which is way higher than historically. And also, other than a brief moment just before the crash in the U.S., it's much higher than the U.S. has ever been either. So we've got lots of supply. It's basically, if people are willing to buy, there's stories about people buying 10, 20 condos at a time. If there are speculators willing to do that, then obviously they're going to buy up all the supply. But it isn't like there's that many people with good jobs that absolutely.
And the only way to get that money to buy the 10 to 20 is obviously through leverage, through the banks. So I guess how much role of it in this obviously big boom that we've had is from the banks.
It's all about. The CMHC is an amazing story. So there's about 1.4 trillion mortgages outstanding in Canada, and about a total of about 1 trillion of it's insured either by CMHC or two private insurers. And there's no other. My research, I was surprised to find out that there's no other country in the world that has anything like that. So what this allows the banks to do. And there's a great article in Maclean's by a fellow, I think his name is Trevor Carmichael, just came out today.
I think I saw that.
And he said that it's the banks can lend as much as they want. In fact, they would prefer that you only have 5% down rather than 20% down, because what they can do then is they can get you to buy the CMHC insurance, and then they don't have any risk at all. Yeah. So if the banks were actually, as in Germany, where the banks have to keep the mortgages on their balance sheet, the rules would be completely different if they were taking the risk. But they're passing the risk off to CMHC.
And that's why the Bank of Canada wants to introduce risk sharing with the banks. That's right. And that's kind of getting some friction, right?
Well, absolutely. And I think Evan Siddall, the head of CMHC that was appointed 3 years ago in December, he's tried to make some significant changes. And I think he's doing some really brave stuff. And it's going to start to... I was shocked to find out, for example, that the lenders can buy CMHC insurance on investor purchase properties more than $1 million. Now, that was shut down as of December 1st, but for several years that was allowed. So why is the taxpayer backing loans that are going to basically speculators that are buying properties worth more than $1 million? The CMHC original mandate was nothing like that. This has evolved into some kind of monster that has gotten completely out of control. So the new head has tried to rein that in, but the last step in it, the risk sharing that you just mentioned, is going to be tough because there's a lot of resistance to that. And on the one hand, the lenders are saying everything's fine, there's no problem, there's no bubble, and on the other hand, if you say, yeah, well, how about if you guys took some risk then? And they say, oh, no, you can't do that. That would totally upset the apple cart, right? So it's either one or the other. It can't be both. Right?
Yeah, I think that's kind of like the real estate industry with the foreign investment saying. There's only 5% of foreign investors, but don't bring in a tax.
Yes. No, it's been a real eye opener. But that what we're talking about now about the debt, that's even a bigger story than the you and I were talking just before we went on air about a story I have of a banker that offered $1 million loan to a couple that I know or was willing to. I didn't bring the couple in. I just described them. that only have 150,000 in family income, and I suggested maybe at some point in a couple of years they might be up to 200,000. And he said $1 million no problem. And then you had a story similar to that, or even more exaggerating.
Yeah.
There's no history that I'm aware of, and I've been doing this, as I mentioned, a long time. There's no history of people borrowing those amounts of money. Those are huge amounts of money, and I don't think.
Well, I think that what's interesting is that seems to become the norm, right? So in Vancouver, obviously, as prices go up, in the last 2 years, 50% or something like that, incomes are relatively flat. And so how do you start to afford these prices, right? So, I mean, it all comes down to the bank's leverage. And I think that taking on the bigger mortgage, the more debt, I think that's become almost, normal. As Christy Clark said, if you don't, what was her quote there? Something to do with debt. If you don't like debt, you don't live in the real world.
Oh, it reminds me of the ice fisherman. There's one ice fisherman out there, and then a second guy comes along and says, "Oh, it must be safe. I drive out on the ice," and he drives his truck out. And then the third guy comes along, and he says, "Well, there's two guys out there. The ice must be safe," and he drives his truck out, and then all three of them get drowned because just because other people are doing it doesn't make it safe. It's almost like it might be the opposite, that if everybody's doing something, this is what we have in the stock market, which is what my main job is. Some of us get really worried if we see that a lot of people are buying, a particular segment like bank stocks, for example. It worries us that the prices are really high and there's a whole bunch of people doing it. There's no history of a huge majority of people being right about a particular investment for very long. It's a real warning sign that maybe it's time to look elsewhere.
Yeah, which I think that's interesting. Someone on Twitter actually had a question for this interview in terms of, the banks, and obviously, the bank stocks are doing quite well. There was a question asking, how at risk are these big banks? And I think there was one guy actually asked if there's a way to short them. But so I'll let you.
Yeah, so the banks, it is true. Like the banks are trading in Canada at a very hefty premium to. So the worldwide average, if you look at Europe or the US, is around 1 to 1.5 times book value. In Canada, the three big banks, Royal, TD, and Scotia, are basically trading at 2 or even a little bit more than 2 times book value. So that's a very healthy premium. They have very good dividends, and they have basically a 20-year track record of raising the dividends and also the share price going up. However, they obviously are making most of their money on lending to households. And household debt, the Bank for International Settlements just on Monday of this week released a report that showed that Canada, we wrote this up for the weekend note that came out today, Canada is at risk of 3 major flags. One was debt growth too rapid, which is debt to GDP. The second one is house prices rising too rapidly. And the fourth one, they've got 4 indicators. The fourth one was if interest rates rose 250 basis points, would people get into trouble? And so Canada's the only country in the world, of those 20 that they track, that had 3 red flags on that. And so yes, the Canadian lenders have done extremely well, but it's also true that if the household debt growth slows down, they will struggle. And I write about that in one of the chapters in the book as to how all that works. It all is linked back to CMHC and the amount of leverage that they're able to use. No other country in the world allows the lenders to accomplish that kind of leverage, because they don't have that magic elixir of the CMHC guarantee that the government backs with their AAA credit rating. Yeah,
so I think another, just a transition on that is, obviously, as house prices grow, this is something economist Steve Keen talks about. As the house prices grow, it's a lot of it is predicated on credit continuing to grow. And so I guess my question is, what happens in terms of when credit starts to slow down? Obviously, we're looking at the U.S. Federal Reserve supposed to be hiking their rates next year and throughout 2017. At what point does the Bank of Canada start to follow? And at what point does that credit slow down? What does that sort of mean for some of these real estate prices? And
so I think there's a couple of things that happens with the lenders and with the borrowers. So the borrowers, at some point, with the new CMHC rules, we don't really have time to get into the details of it, but people can read about it. But the changes are pretty significant. There's some announced in September and a big batch I referred to that came in December. So it's really too soon. We're just here in March, so we'll see it over the next few months. But if on top of that interest rates were to rise, then you would have a really significant number of people. The real estate industry is already saying that something like maybe 20% of first-time buyers might not be able to qualify for those loans. So that the people don't realize, I don't think generally, that the first-time buyer is extremely important to the market, because people my age, when they sell and buy, they generally already own a home, so they're selling one to buy one.
Yeah.
It doesn't have a big impact on the market. The new money that comes into the market basically is through the first-time buyer. So if interest rates were to rise, there'd be two problems. One is the debt service ratio would be difficult for a lot of people that already have bought. But generally people are able to hunker down and just, but it hurts the economy because they cut out vacations, they cut out restaurants, they cut out hockey tickets when they basically have to.
It's a vicious circle.
It really is. The consumer spending and this is what happened in the U.S. And then the second thing would be that a lot of potential buyers would just be forced to go into the rental pool. So what happened in the U.S. is quite instructive. The companies that had a large number of rental units did really well because there's a whole huge millions of people that were forced to go into the rental as opposed to, and a lot of them are still in the rental pool. They're not necessarily jumping in to buy, and that's because of the changes in the financing that were put in the U.S. after the 2009 crisis.
What I know you talked a little bit on the first-time buyers and obviously how important they are to the market. What are your thoughts on obviously the BC government, Christy Clark's first-time buyer loans to help them get into the market, obviously matching their down payment?
The head of the CMHC said he was giving a speech in England to the I think it was a symposium put on by the Bank of England. It's available online, but he said he doesn't see that anything like that really helps the buyers, because it really all it does is inflate the prices of houses. So it's really only helping the sellers. So it doesn't help the first time buyer. If they get a loan like that, they get deeper into debt and the prices go up, they're really worse off than they are. People think of course, I lived through the early 80s when interest rates literally were 15% for mortgages. And people say, that must have been awful to buy a house when interest rates were 15%. Yeah. But actually, there's another component to it, is house prices were less than $100,000. So it actually, when the interest rates are high, it pushes house prices down and everything becomes more affordable. And the other thing, of course, is everybody was paying off the mortgages as fast as they could. Exactly the opposite today.
Yeah.
Like people... Today, the mantra is, just put it on the line of credit, because you don't even notice if you add another 10 or 20 or 30,000 to your line of credit. You don't even notice the change in the interest rates.
Yeah, exactly. So you're talking about obviously higher interest rates. So right now we're probably in a period where arguably there's nowhere to go but up for interest rates. So, I mean, how do you see that kind of playing out, and where do you see it maybe in the next 1 to 2 years? Where do you see interest rates? Well, I mean, I know it's a hard.
Today's Friday. The employment report in the U.S. came out, and obviously next week, March 15th, Janet Yellen, the Federal Reserve, is going to raise rates. I think that'll be a quarter of 25 basis points, and that's the second or third. I guess that's a third increase. But they're talking about 5 more increases, so that would be another 125 basis points, 1.25%, and rates are already higher in the U.S. than they are in Canada. So a lot of people have, I think, in my opinion, the mistaken idea that somehow interest rates can stay low in Canada even when interest rates in the U.S. rise.
What's your thoughts on that? Because there's people that say, the Bank of Canada won't follow because the Canadian economy simply isn't strong enough. So I mean, but again, at what point, how far can they diverge?
Well, I think the problem with that analysis is that people assume the Bank of Canada can control interest rates, and they can't. The one interest rate they can control is the very short-term interest rate, like basically the overnight money rate. But if you look at the 5-year rate, which is what's used to fund mortgages, is basically wealthy people that put their money into a GIC or whatever, a term deposit, and they want to get a return. And if they could get a better return in the U.S., like the 5-year rate in the U.S. is already way higher than the 5-year rate in Canada. The 5-year rate in Canada has gone up to 1.25%. The 10-year rate in the U.S. is 2.6%. So if somebody could get a better rate of return in the U.S., and on top of that, if it looks like the U.S. dollar is going to be stronger and the Canadian dollar is going to be weaker, then the money flows out of Canada and flows into the U.S. And the next thing you know, there's a real shortage of money available to buy houses. And that would mean that not only would the cost of mortgages go up, but just the availability would be difficult.
Yeah, exactly. So I think it's like, regardless of whether Canada decides to hike their overnight rate, that we're almost automatically going to absorb higher fixed term mortgage costs, higher 5-year.
Yeah, and I think too that people forget that if in that scenario, obviously the Canadian dollar would drop below 70 cents, and that tends to feed in a lot of inflation into our economy. So it's going to be very hard for the Bank of Canada if inflation is currently quite mild at 1.5 or 2%. If it ticks up to 3%, you can't have mortgage rates less than probably about 5% if inflation is 3%, because there has to be a premium.
Yeah.
And that wouldn't be in the control of the Bank of Canada. The Bank of Canada and Canadians would just have to go along with that. We wouldn't really be in a position to fight that. So if the trend is up towards higher interest rates, Canada will have to follow along.
Yeah, interesting. So, I mean, obviously we'll kind of gear towards wrapping up here. Is there any kind of things that you would want to add or input or?
I think to me, going through this process with the board, I mean, this isn't really my main job in terms of, my main job is investing and advising in people on their investments. And but this has been a real eye-opener. And the thing that still shocks me to this day, which I'd like to mention, is the amount of debt that people are taking on. It's just absolutely the leverage in society. And Canada's been singled out by the fellow you mentioned, Steve Keen, as one of the 7 countries in the world that is at risk of a major financial crisis. And it's entirely because of the private sector debt, primarily household debt, but also corporate debt. And that's a very high risk because we don't really have the option to go out and maybe refinance it, like maybe the people in the US would, because the US being the reserve currency. So that's, if people are thinking about, should I take on that mortgage, that $500,000 or even $1 million mortgage, I would really advise them to be careful, because if somebody gets caught with a lot of debt and we have a normal cycle, a recession or whatever, that could be very devastating to their financial future.
Yeah, I think Steve Keen actually made a good point in one of his interviews. He actually says that high house prices, there seems to be a misconception that high house prices, create a wealthy economy, but in fact they actually impoverish it. So,
well, it's the concentration of borrowing and investment into the real estate industry is really unfortunate, because it's really an investment that doesn't produce a lot of productivity, a lot of innovation. What we really should be looking at is innovation, research and development, new products. I mean, we used to have BlackBerry and all that stuff in Canada, and now all we have is a bunch of houses, right?
Yeah.
It's really, I mean, obviously it'll change, but the restructuring of society and the economy away from the real estate obsession is going to be, it'll be very, very difficult for some people. It'll be a great opportunity for some people too.
Yeah, I think so. I think there's obviously, it'll be interesting to watch how the next kind of 1 to 2 years sort of play out. I think there's obviously, these kind of markets always make for interesting opportunities and whatnot. But
yes.
I want to thank you for stopping by. And obviously anyone that's looking for it, it's called When the Bubble Bursts. I think you can get it at Chapters Indigo, Amazon. Whether you're a real estate bear or a real estate bull, I think it's always good to get different perspectives. And I want to thank you for coming on, and hopefully this provides some good value for everyone.
Yeah.
Alrighty. Okay, thanks a lot, guys.